All right, welcome to Windridge Apartments. My name is Tyler Dever. I'm the lead sponsor of this project, and I get the privilege of walking you through this thing. You know, we are pumped about this property. It's a 46-unit property in Columbia, South Carolina, and seriously, I'm excited to walk you through, okay? Columbia is booming. That's the good news. The bad news is Columbia is booming, okay? And what I mean by that is because of that, there's a whole bunch of operators who are trying to come in. They're willing to overpay in the Columbia market, hoping to gain a foothold there, right? Which means competition is strong. We're not willing to overpay though. And we already have a solid foothold. We already own over 1,000 units in this same market. But regardless, it has caused us to get creative with finding solid off-market opportunities. And Windridge is a byproduct of that creativity. You will see that as I walk you through, okay? So first, I'll give you a snapshot of what the exterior looks like, and then we'll dive into the rest of the presentation to get into some of the nitty-gritty details, okay? Here you go. Stunning, right? I'm kidding. Okay, let's be honest. There is nothing really stunning about the exterior. Parking lot's beat up, not much color to the exterior. There's even a tenant that has his garbage can out overflowing with garbage. You probably should have recorded that video after garbage day. I don't know. You know, which may beg the question, like, why all the excitement for the property then? And oddly enough, it's for a lot of those same reasons. You know, there is massive opportunity that is packed in, or opportunity or potential packed into all those things. You'll see that. You add in, the demand that these floor plans have, how content current ownership has been, the ideal location. The property is located in a great spot, and then how ridiculously far below market rents they are. And you'll begin to see why Windridge is absolutely stunning. Okay, let's dive in. Now I have to cover some legal disclaimers. And what I'm going to do is I'm going to get my mug out of the way from this way, this point on, and so that you can see the slides and everything that's on there, okay? So a couple legal disclaimers first. What we're about to go through is not an offering, right? The official offering will be done through a private placement memorandum, which will outline the risks and the terms of the deal. This presentation is for informational purposes, right? It's not intended to be a general solicitation. Also, by accepting the presentation, you agree to keep this information confidential and use it merely as a way to evaluate a business relationship with my partners and I. Also, the returns that we're about to go through, right? Those are forward-looking statements. I don't know how to predict the future yet. I wish I could, but I cannot. I'll let you know if that changes. So that being said, right, all forward-looking statements are based upon our projections of the market, the asset itself, and from experience with other properties in this same market. We own a little over 1,000 units there. But with everything, right, this investment is subject to uncertainties that could cause, the actual results to vary. And that's what the private placement memorandum does, is the PPM. It will outline a number of those risk factors for you to consider, okay? So we'll dive in. I'll skip past this table of contents here and dive right into the investment. What I'm going to do is I'm going to give you this high-level overview of the investment before diving in. And then we'll dive into everything, in more detail. So Windridge, once again, 46-unit townhome-style apartment building, built in 1984, consists of 23 duplexes, all of which are 2-bedroom, 2.5-bath, which we love that unit mix and that floor plan a lot. And it's located just 6 miles north of downtown Columbia, South Carolina. Now, how we sourced this deal, I think I mentioned at least that this is a true off-market deal. And the reason that's attractive, that allows us to avoid a bidding war, right? If we have a lot of competition coming in, a bidding war drives up the price. We were able to source this directly from the seller, which allowed us to sidestep that. The seller had owned it for 20 years. His son has been running the property that entire time. And now the seller's looking to retire, and why they're exiting the property. They actually had another offer interestingly enough, they had another offer on the table. And when we approached them, they were adamant about a purchase price of $4.3 million. We got a little creative with how we approach this though. Greg and Lisa are our partners out there in South Carolina, and they have 2 young boys that run this business with them. And they brought their boys with them, Adam and Eric, to the first initial walkthrough. And the seller loved that. The seller loved that they were a family business just like he is. And it allowed Greg and Lisa this foothold into being able to create a relationship with the seller. And not only were we ultimately able to win the deal, but we were able to negotiate a purchase price of $3.72 million, which is well below market value. You'll see that as we go through. It just proves once again, though, that relationships are absolutely key in this business. We'll be raising a little over $2 million, $2.2 million for the project. As per usual, as sponsors, we'll be covering, guaranteeing the loan first off, using our net worth, liquidity, and everything to guarantee the loan. And then we'll also be investing in this deal alongside you guys. We're going to cover approximately a little over 5% of the equity needed for the project, which once again means we'll be invested right alongside you, and we'll be offering a preferred return to our investors of 7% and projected annualized returns of just over 19%. Now, this offering is available for accredited and sophisticated investors only, with a minimum of $100,000. Funds will be due by January 29th, and positions will be determined on a first-come, first-served basis. I will say this, those of you who are wishing to invest less than $100,000, I know that we've talked to a couple of you, you can request to be put on a waiting list, and what we'll do is we'll notify you with, if any smaller gaps need to be filled in. And then if those positions do arise, this is a smaller raise than we typically have, so those will probably go fast, but if those positions do arise, those will also be on a first-come, first-served basis, and we can notify you of those if they come up. And then lastly, distributions will be sent quarterly, with the first distribution scheduled in quarter 3, right? A couple quarters after closing. Allows us to get everything put together on the project, get it stabilized before we start sending out distributions. So Q3 is when we plan on sending that first distribution. All right, to get an understanding of the value potential on any property, right? We're going to look at a number of different drivers in the market. One of the most important being the rent comparables. Now, these properties are valued by the cash flow. We want to know how much cash flow, how much potential is there for us to increase, right? We own a little over 1,000 units in the Columbia MSA right now, so we're looking at those market comps all the time, monthly basis at least, right? And what we do is we choose our competition based on a couple things. Asset vintage and the grade of the asset, the proximity, how close it is to our target asset, and then comparable amenities as well as unit size. Windridge is a C+ asset, neighborhood we would consider a B neighborhood. It's built in 1984, like I mentioned, and has each unit is 1,200 rentable square feet, and the average rent on the property is $750. You compare that with assets with similar amenities in the same proximity, but with smaller unit sizes, and those properties have an average rent of $1,200. So I want to put that in perspective, right? Average rent on our property $750, market rent's $1,200. We're going to run all of our projections here now off of $1,100. Can we get to $1,100 per unit? And if we do, what does that mean for value on the property? I want to point that out. At $1,200, that's a gross potential rent of $662,400. Compare that to our gross actual rents on the property right now of $414,000, and that is $248,400 lost to lease. In other words, that is how much money the current owner is missing out on annually because their rents are so low and they're not up to market. We're conservative investors though, okay? So once again, we're going to pull the loss to lease, and we ran those numbers off of $1,100 instead of $1,200. So with that means that annually or monthly we'll be able to recapture about $16,000 of income. Annually, that equates to $193,000. And with those numbers, once again at the lower, $1,100 per unit, that is an additional value of $3.7 million that we'll be able to bring in from the rents alone. That being said, though, okay, I want to explain why the loss to lease is so high. There is a reason our rents are so much lower than the competition. And in short, that's because there's some work that needs to be done on this property. in order for us to truly compete with the market, there's work that needs to be done. And all of that work that needs to be done has been accounted for within our projections. As we get further into this as well, you'll see that our return projections are also very conservative. For example, we've accounted for $2 million in equity creation over a 5-year hold. You can see from rent collections alone that will be, or rent increases alone, that'll be more than that. But once again, we understand that there are risks, right? There are risks with any investment in any environment, and Windridge is no exception to that. So what we do, right, you'll understand how we mitigate those risks. And one way to mitigate risks is to be extremely conservative with underwriting projections. Another one is to understand market trends. And we love how Columbia is trending, and we've also been extremely conservative, which you'll see. So first off, market, okay, with Columbia and South Carolina as a whole, there are 4 major influencers that shape what people buy and where they live. Government, the economy, technology, and societal shifts. They change the future just like they change the past, right? So we look at those anytime we're going to, branch out into a market. So government, South Carolina is one of the most business-friendly states in the entire nation. They're ranked number 1 for incentive programs, number 2 for cooperation in regards to the government. The economy is also very strong. Even right now, South Carolina ranks number 16th in the country due to a strong business environment. Columbia was ranked the 14th strongest metro by Business Week. And that has certainly shown, as they've been one of the top 25 in the country for job creation since May. And then technology as well. So we love this. University of South Carolina is home to, it's like a 40,000 square foot tech incubator. Houses 45 young tech companies, which makes them one of the top 3 tech incubators in the entire country. And that obviously bodes well for future growth. It's already having an impact on the market as we speak. And then societal shifts. We're looking at those kind of things as well. Those born from 1989 to 1993, they constitute the largest 5-year age group in the entire country. These now 28 to 32-year-olds have been slow to form households, but they are going to lead the addition of nearly 6 million households by 2025, meaning they're finally moving away from home, which is great. And the reason that's important is according to a study done by a smart asset study, Columbia ranks number 2 in the nation for millennial cities with an average age of 28.3 years old, which is great. Now here's a quick snapshot of the return projections. Okay, this diagram shows you the return breakdown for each $100,000 invested. So cash flow returns will be $31,500. Your equity returns will be $65,350. You add in your initial capital with that, and that equates to $196,850. So essentially, you've turned your $100,000 into $196,000, which equates to a cumulative or an annualized return, right, of 19.4% annualized. Now, I want to touch on that though, okay, because I want to touch on return projections. And those of you who have been investing with us for a while, you know that we don't take return projections lightly. Projections are awesome. Don't get me wrong. Optimism is great too, okay? But there are a lot of things that can wipe out initial return projections and the initial optimism that goes with those, right? We are acutely aware of that. We take that into account many times before we ever show you, return numbers on a screen. Even when we show the numbers, you'll see that we're very conservative. Take the cash flow returns for an example. As I outlined a couple slides ago, when we implement the business plan, cash flow will increase, not even a question. We don't account for that increase though in our projections, right? We only account for the base preferred return in our projections. That's because in real life, things don't always go according to plan, right? They don't always go according to plan. As great as the property and the area are, they should never be the deciding factor. The largest factors behind deal performance are the operators behind the deal. You take your eye off the ball, even the best assets in the best markets will underperform. On the other hand though, like a solid operator can cause almost any investment to exceed projections. So yes, we're conservative with our projections, but you will never hear us shy away from those return projections, COVID-19 or not. Okay, it's because we know what it takes and we're dedicated to getting there, and you will see that through our track record. You know, as a partnership, we own a little over 2,800 units. 1,000 of those are in the Columbia MSA. And those, 2,800 units and years of experience, right, don't come without mistakes. Once again, those of you investing with us since the beginning can attest to that. Okay, what we've learned from those mistakes, though, that's what makes us valuable as a partnership, right? It also what makes us confident in our ability to meet and exceed returns. I mentioned this, but in real life, things never go as planned. The initial plan is important, don't get me wrong, but that isn't what exceeding return projections come down to. Exceeding projections, it's in direct correlation with the operators, our ability and willingness to solve problems. Outside circumstances will inevitably affect the path, but it is our job as operators to make sure that they don't affect the destination. We believe that to our core. I would never want to believe otherwise. So, to those of you who have been investing with us for years, first off, thank you, right, for sticking with us through those learning lessons and continually trusting us with your investment capital. I mean, there is no way that we would have been able to acquire as much real estate, $187 million in real estate, without y'all. You've played a role in almost every single one of those acquisitions. So regardless of whether you'll be joining us for this one or not, thank you. Sincerely, thank you very, very much for your continued partnership. And then for those of you who will be investing with us for the first time, welcome aboard. Right, I promise that we'll keep those learning experiences to a minimum moving forward, okay? Walk you through some of our track record and who we are. All of you know us, one of us or some of us somehow, right? We have included a more detailed breakdown about each of us farther in the package. I think it's like pages 46 or something that you can take a look at. As per usual, though, I want you to feel free to reach out if you have any additional questions about us or the investment. Our contact info will be found on the last page of the property packet as well. The high-level overview of us, though, okay? Greg and Lisa Parrish and their sons Adam and Eric, they make up GLP Investments. They have a home in North Carolina and here in Columbia, which is great, and they split their time between those two areas. And they are, in my opinion, one of the primary reasons, if not the primary reason, that you invest in this property. They are amazing asset managers and such a value to sourcing deals and everything that they do there with their relationships. They're also the founders of Omni Management Group. They have 11 years of property management experience, which makes them a wealth of knowledge that we learn from, I learn from personally every day. Very grateful for their partnership. They will be at the property regularly to oversee capital improvements and operations. You also have Ryan Woolley and myself. Once again, my name's Tyler Devereaux. We're the managing partners of Multifamily Capital Partners, and we'll act as the lead sponsors of the project. We'll also oversee investor relations, business operations, and financial asset management. And then Sarah Sullivan, to wrap everything up, is the founder of Sugo Capital. She's also the host of the Confident Investor Series and the Women's Wealth Show. And she will assist in investor relations and business operations. And she has a brilliant operational mind. You'll see that. And then all of us, once again, will participate in due diligence and acquisitions, amongst some other things. Now, here's a quick snapshot of our track record, okay, which is outlined in more detail later in the package as well. Once again, I think that's page 38, around there, okay? We've taken 9 properties full cycle. Our average cash-on-cash return to investors is 10.43%. That exceeds our average return projection of 7.85%. Average annualized rate of return, also known as the ARR, that's a whopping 79.28%. That being said, though, I always have to clarify, that is inflated by a property called Newell Crest, which is a property that Greg and Lisa used creative financing on. And long story short, they turned $45,000 into $800,000. I do not want any of you to have that expectation, okay? So if you take that property out, and I've noted that on the slide, but if you take that property out, our averaged annualized rate of return amongst other assets is 47.35%, which once again far exceeds our average return projection of 22.71. And that equates to a little over $24 million in equity created on the projects that we've taken full cycle. Now on the projects that we currently, our assets that we currently have under management, values a little over $150 million. Our average occupancy is 94.38%. That's portfolio wide right now, with just over 36 million of equity created on those projects. We've leveraged our lending connections and our track record to source a new Freddie Mac loan, 7-year term, 2-year interest only period, and has a fixed rate of 3.8%. It's the best interest rate I've ever had on any property that I've ever acquired, which I'm excited about. The hold time will be approximately 5 to 7 years. And in a nutshell, our strategy will, during that time, will be to reduce expenses. We'll do that through operational policies and procedures that just currently are not in place. Then we'll also maximize rent increases by upgrading the interiors to a premium product, and I'll walk you through that. And then also, we'll clean up the exterior to boost some renter satisfaction as well. Those improvements, which I'll show in greater detail in just a second, break down to a little over $13,000 per unit. All right, those are the highlights, okay? Now let's get into some more detail about the property itself, okay? So here's a map to give you an idea of the geographical layout first. Windridge's location is one of the highlights of the deal, no question. We have all sorts of retail, restaurants, other conveniences nearby. We're Costco, Publix, Food Lion, Walmart, they're all right down the road. We're a few minutes from Fortis College, which has nursing, dental, healthcare programs. We're less than 10 minutes from University of South Carolina, downtown Columbia, also Lexington Medical Hospital. You're not far from Riverbank Zoo and Gardens. You're close to I-26 and I-20. All of those provide really easy access to all the other major interstates as well. Zooming in, you'll get a better idea of the parcel layout. These individual cul-de-sacs that you see, they sit off a road called K Road, which is very quiet, and it's lined with trees. Seriously, it's a very beautiful road. But the beautiful part is K Road sits right off of St. Andrews Road, and that's a major road. And that intersects right into the freeway. It has access to the interstate, I-26, and it's literally a block down the road. So it's this perfect mix of quiet and convenience, right? Which is great. So as a whole, though, once again, the property needs some work. Some light landscaping touch-ups, as well as some upgrades on the interior will make a huge difference. So what we're going to do, we'll go into the property, just a couple of pictures of the exterior. Once again, in fairly decent shape on the exterior. That parking lot, though, is in pretty rough shape. So our exterior upgrades, most of our CapEx budget will be used for interiors, but we will improve the exterior, okay? The parking lot is the biggest project, will be one of the biggest projects. They are, once again, just in rough shape. Getting those resurfaced will have a huge impact on that property. It's one of the first things we noticed when we pulled in for our initial walkthrough. You couldn't notice it. I mean, you're up and down in that parking lot. It's rough. Also, what else we'll add, because we have families, a number of families on the property, we'll add a playground. That'll be a huge hit. We'll also do some minor cosmetic upgrades, by painting the shutters to add some color, cleaning up the landscape, adding new signs. We're not going to rebrand. We typically rebrand the property, but this property actually has a pretty good reputation. So we will update the sign, though. You saw on the other slide, it's pretty outdated sign. So we'll update the sign, give it some more better visibility, and then just a better design. And then we'll also add a banner that says, premium units, new ownership, management, that kind of stuff. I mentioned earlier that one of the reasons our rents are so much lower is because the interior upgrades are out of date. I want to talk about some of those things, okay? Currently, everything is cosmetically from the 80s, which means they're outdated first off. They have original cabinets, old carpet, tan and white appliances, as well as, dated lighting and plumbing fixtures. These are easy fixes that we know will pay huge dividends. Month to month, tenants is one of the things, I can't remember if I mentioned that or not, but we have a number of tenants that are month to month. And most of the time we would view that as a risk. And it is a risk to have month to month tenants. But that risk, when handled correctly, is also a huge upside. For example, the rents are low on this property because the current interiors are out of date. But we cannot update the interiors until a tenant chooses to vacate. So when a tenant chooses to vacate, I'll walk you through our takeover strategy, in just a minute. But when a tenant chooses to vacate, what we'll do is we'll turn those units into a premium product, which will allow us to, bring a new tenant in and immediately bring those rents up to market rates. So because some of the tenants are month to month, we can execute that plan a lot quicker. That's actually a huge upside on this property because of that. And we're very familiar with this business plan, by the way. If you look farther down the road into our track record and the details, there's 2 properties that I could point out immediately. Cedars is another 40-unit property we took over, and also Colonial Village. Both of those had month-to-month tenants and very similar properties, especially the 40-unit property, very similar as far as everything goes, as far as the business plan. Same strategy, and you'll see that, as you look at those, the Cedars and Colonial Village, awesome returns, and it's because we were able, and awesome returns quick, because we were able to go in and maximize rent increases right out the gates. You'll see that outline below. Interior upgrades, okay, the beautiful part about Windridge is the floor plans are awesome. You can update interiors easily, but it's not easy to change the floor plan, obviously. The floor plans, I think I mentioned this, but they're 2-bedroom, 2.5 bath, they're townhouses. Just that floor plan is not easily found within the Columbia market, especially one that operates as an apartment and has the benefit of an apartment building. The owner has kept up with basic things, right? Like, so the HVAC systems, they've kept up with those. Many of those HVACs are actually, HVAC systems are actually new, but they did nothing beyond what they needed to, right? Beyond what they had to. So our plan is to go in and make premium units and raise the rents once again, pro forma to $1,100. The premium units will have, new gray plank flooring downstairs. That'll also be in the upstairs in the hallways. And then the bedrooms and the stairs will actually have new carpet. We'll also add, either black or stainless steel appliances, new light fixtures, fresh 2-tone paint, new or nicely painted cabinets and hardware, newer resurfaced countertops, upgraded bathroom accessories, and then new brushed nickel door handles as well. Once again, all of this has been accounted for within our projections and will have a huge impact for sure. I mentioned this already. Properties made up of 2-bedroom, 2.5 bath, large townhomes. The amazing thing is this true townhome duplex, once again, is just rare and highly favorable in that area. All of them have a fireplace, by the way, which is also very favorable. We have another property just down the road that also has fireplaces, and it is a home run. Tenants love that. Also, they'll complement our nearby properties. Complement them perfectly. Rivercrest is a property that we own just down the road from here. Those are all 3-bedroom units. And then Tropical Ridge, that's the one with the fireplaces, is a couple miles away. And they're all 1- and 2-bedroom apartments, but they're not townhomes. So they complement the other assets that we have nearby perfectly. The major drivers, poor management, poor operations, below market rents, and those are the major drivers in the property. Our management company, Omni Management Group, will take over immediately after closing. We'll begin to implement operational systems that will ultimately bring the expense ratio down to market average. Currently, the owners are operating at about 8% above that mark. And for reference, when we bring the expense ratio in line with market average, it results to more income to the bottom line, which also increases the overall value of the property. They've actually maintained 100% occupancy, but they've done that through low rents and market demand alone. And I'll say this, they actually do have a pretty good reputation, okay? And that certainly helps. They just aren't the best operators. And once again, the reason being, okay, they're comfortable. Once again, they've owned the property for 20 plus years. They're profitable with the numbers that we've talked about, and they are very, very comfortable. But comfort, right, is one tricky son of a bitch, okay? Because it might be less work, but it also is a lot less money, which causes you to actually work longer, in my opinion, harder as well. That comfort is causing them, to put that in perspective, is causing them nearly more than this, but $200,000 in yearly income that they're missing out on. And it just cost them millions of dollars as they're exiting the property. The good news, their comfort, right, has left all that potential on the table for us, which we are ecstatic about. I'm okay with them being comfortable, okay? Let me quickly outline the takeover process, okay? The number one reason people leave is maintenance requests. It's because either they're not being done or they're not being handled properly. And then the number one reason people decide to renew is a sense of community. It has very little to do with rents. What we found is people, especially in this quarantine type environment, have just this need for connection. And they want to know you care too. That's been very, very evident over the last few months. Each phase of our takeover process is designed with that in mind. The focus is building relationships and removing tenant concerns, and then obviously building momentum. So that all starts in phase one, okay? Phase one, it all starts there. We do that by reaching out to each tenant individually to inform them of new management. The goal of this is threefold, right? Number one, to start building a relationship. Number two, to start putting a plan in place for any outstanding maintenance requests. And then number three, to just start setting proper expectations in regard to our operating procedures. And then phase one also includes exterior improvements, telling them that we're going to be different and that we care, that's one thing. But momentum truly starts when they start seeing those changes. So before we start going into increased rents, right, we start sprucing up the exterior so that they see those changes. So every tenant see those changes and see that we care. And then phase two will be centered around keeping that momentum and mitigating risk. So that will be evicting any slow or non-paying troubled tenants, which we haven't found any of those yet, which is great. But it begins to also set proper expectations and keep that positive momentum. What we then do is, we've identified every tenant, we've already identified this, every tenant that has a lease expiring in the next 90 days or that is month to month. And what we do is we contact them, right? And what that allows us to do is get a pulse on upcoming turnover, right? What's coming down the line. And then what we do is that allows us to spread out lease expirations and start renewing leases at increased rents once again. And that allows us to plan for make-readies. And what that does is reduce our turn time, right? So instead of it taking 7 days to get a unit ready, we know everything that needs to be done. We're able to get it done in 2-3 days, especially with the work that we're doing, and maximize rent gains and recapture rents from new tenants coming in. And then phase three will be where the bulk of the capital improvements, start to happen, both interior and exterior. And obviously some of those will be happening simultaneously within the other phases as well. The CapEx breakdown. Okay, so the capital improvements are broken down in detail right here. We've accounted for $609,000 in capital improvements. The bulk of that will be used to upgrade the outdated interiors that I just walked you through. The other side of that, we have the resurfacing the parking lot. It's about $250,000. $10,000 to spruce up landscaping and painting the shutters, and then $3,000 for new signage throughout the property. That being said, though, I want to be clear, we bid out every single project, and most of those we even bring in-house. And we do that because what we do is we want to come in under budget on these items, obviously. When we do come in under budget, those extra funds go into a reserve account and are distributed to investors when appropriate, right? But that is a way that we can mitigate risk, is making sure that we're bidding out on our current projects, building our reserve accounts, and then once they get to a point where we're comfortable, we can distribute. This is one of the reasons we love Greg and Lisa and why they're so extremely valuable with what we do. They're some of the best operators that I've ever worked with, and they're very good at bringing in, they have great relationships as well, but they're very good at getting things done in the most cost-efficient way. So once again, I'm very grateful for that. It plays a huge role. Also, the most important stuff, okay? The stuff you really care about, which is the return summary, okay? Let's dive into this. So slide 27 here, okay? This shows how the $2.2 million that we're raising, that equity we'll be raising, it shows how it will be utilized, right? So the down payment will be 28%. We love that. It keeps the property well leveraged. And we just outlined those capital expenditures of $609,000. The acquisition loan guarantor fee is $186,000. This is the fee that gets paid to us as sponsors for, once again, guaranteeing the loan. We're the ones signing on the loan, covering up any upfront costs, earnest money, and due diligence costs, and then of course just putting the deal together as a whole. Closing costs, $111,600. 1% for loan points, it's $27,900. And then we also keep a property tax reserve as well as principal and interest reserves. Brings the grand total to $2.2 million. Now this slide shows a breakdown of side by side of the financials, okay? The numbers on the left, those represent the current numbers at takeover. And the ones on the right are projected year one numbers. So we will increase the NOI by $24,881 in year one. And we will do that by executing the takeover plan that was outlined, right? Which will reduce vacancy and turn times as well as concessions and allow us to turn, at a bare minimum, 30% of those units to a premium product in year one and bring those rents up to market rates. Here's the 5-year pro forma breakdown. I want a couple things to note. There's a lot to see on this slide, okay? So I'm going to walk you through this again. And there's a couple things to note as you look at these numbers. Our rent growth, okay, we are currently 35% below market rents, but we will start to recoup that quicker than normal because once again, a number of the tenants are month to month. That being said though, our projections reflect far more conservative than what we feel like we'll actually be able to recapture in the time frame we'll be able to do that in. So year one is 16%, year two is 18%, and year three is 14%. Is what we'll be able to recapture, what we're projecting. And then that tails down in year 4 and 5, which is 6 and 7%. Okay, very conservative there. We keep vacancy right around 5% each year. The property is currently 100% occupied, but we will definitely have occupancies as we start to raise the rents. And then we have bad debt. Bad debt is estimated at 2% for the first couple of years and then 1% each year after. For reference, bad debt is a receivable that is no longer collectible, right? Such as rents that weren't paid. And then expenses, as we bullet point these expenses, we account for a 5% increase for property taxes each year, and then a 2% increase, every other line item per year. We found that gives us enough of a buffer to still hit our projections. I will note this though, the only line item that isn't increased by 2% each year is the property management and asset management fees. Those are fixed fees. Payroll, we have full-time employees that for the property, which is what that line item accounts for. And then our CapEx reserves. The lender requires $300 per door in capital reserves each year, and that number does not change. We'll use those for capital expenditures, for the property when they arise. But like I mentioned earlier, we are required to keep a reserve account with the lender as well. We also have a solid reserve account. Debt service. Fixed at $104,603 for the first 2 years, but then it jumps to $153,906 in year 3. We have a 2-year interest-only period. That's why the payments are lower for the first couple of years. And then it expires and we start paying off principal and interest, and that's when the payment jumps. But once again, we'll be paying the principal down at that point. And then once again, cash flow before taxes in year 1 at $79,494. Now, this is a breakdown of the net returns of the project, okay? Once again, equity partners will receive a 7% preferred return. And then from there, equity partners will receive 70% of the cash flow profits. But I'll say this, if those returns do not hit the 7% preferred return threshold, what we'll do is we'll increase that percentage until it does, right, to make sure that we hit that. So you'll be able to continue to carve out more. Returns from cash flow, 31.5%. Once again, we're conservative with our cash flow returns. We haven't based those on anything more higher than the preferred return. And then returns from equity, 65.35% for a total return of 96.85%, and which breaks down over 5 years to 19.4% annually. Now the graph in the middle there, okay, this chart in the middle, provides a more detailed look at the equity breakdown at resale. Okay, we've accounted for 5% resale costs, 1% disposition fee that's paid to us as operators once we exit the property. And then according to projections, once we've covered, the loan repayment of $2,752,500, paid back, the initial equity investment of $2.2 million, we will have created just I think it's just over 2 million, yeah, 2 million of equity in the property, and 1.43 million will be split amongst investors. That brings total project cash flow returns and everything in place there, right? $693,000. The only return, I'll bullet point one more thing. The only return metric I think that I haven't shown you yet is the IRR, which is calculated at the bottom. That stands for internal rate of return. And if we hold the property for 5 years, that will account for an internal rate of return of 15.7%. All right, market stats. Okay, the Columbia, South Carolina market hits every major indicator that we have. You know, it's one of the reasons that we're so committed to that market. You know, those indicators: job growth, job diversity, household formations, population, stuff like that. So the South Carolina market, you know, 12% below average for U.S. cost of living. Top 5 most productive workforces in the U.S. 6 major universities. It's also obviously an upside there. You know, household formations have increased by 2.23% over the past 12 months. Our qualifier is 2% plus. You know, household growth is actually projected to increase by 3.2% over the next 5 years, by the way. Population is, you know, swelled by, it's 12% over the past 10 years. And our qualifier is positive growth over the past 3 years, as well as projected growth. And then employment growth has increased by 3% over the past 12 months as well. That took a hit in April, but they have consistently raked in the top 5 for positive employment changes since May. And then lastly, over 50% of U.S. renters are under the age of 30. And the median age in Columbia is 28.3, which we love that. It's another reason why this rental market is so strong, okay? We always do a market survey of our competition as well. We do that by taking a threefold approach, okay? We don't just guess what our market, our competition is. We look at this in detail. So threefold approach. Number 1, call them or visit the property and pose as potential tenants. Number 2, calling them or visiting the property and interviewing the manager on site and just telling them exactly what we're doing. We found that to be very effective. And then lastly, we have our property management company do the same thing. We found that that's the only way to get true up-to-date information to determine what our true loss to lease is. Now we choose, in order to choose the competition, we choose our competition based on asset vintage, which is when it was built, grade of the property, the condition it's in, proximity, how close it is to our apartment, and then comparable amenities and unit sizes of the property. So, you know, there just are not a lot, by the way, almost any true duplex apartments in the area. But this gives you an idea of how far below market rents we are at Windridge. We already talked about it. This is just these are the closest apartments to our complex. Glen Eagle 975, that was just purchased though, and they are in the process of repositioning and raising rents as we speak. And then you have Landmark, which is at 1106. We did the math once again on what that breaks down to. I already walked you through that process. All right, with that, let me get you into some next steps here, okay? Okay, we've bullet pointed a whole bunch of those things. There is more detail in the property packet that goes through, once again, some of the sales comparables, as well as us as the management team and our bios and everything there. Feel free to look through all that. The investor portal, every one of you should have had access to the investor portal. You're probably watching this video on the investor portal, right? We have spent good time putting this together to make sure you have everything at your fingertips, okay? So with that, the next steps on that. Once you've reviewed the offering, awesome. You should see a yellow button, right, that says invest now. If this is, if you're ready to take that next step, click invest now in the top right corner of your data room, and you can do that and start to begin the process. And then from there, you'll be able to sign, the private placement memorandum, review the private placement memorandum, view the investor portal, and everything with the wire instructions there. I want to be clear too, though, at any point in this process, if you have more questions or anything, feel free to reach out to any of us, and we'll walk you through any of those things. But the investor portal makes it very easy to just digitally sign and get everything done. Once again, as a quick reminder, this offering is available for accredited and sophisticated investors. Minimum investment $100,000, and funds are due by January 29th. We already have a bunch of soft commits on that as well, but regardless, even if you are one of those soft commits, you'll still need to make sure that you get all your paperwork and everything done by that time. Once again, those are based on a first come, first served basis. And then those wishing to invest less than $100,000, once again, can request access to be put on a waiting list. And then distributions, lastly, will be sent quarterly, and first distribution will be sent the third quarter of 2021 is when that's scheduled. And then last page, you'll see our contact information. Melissa is our investor relations specialist for Multifamily Capital Partners. Ryan Woolley is my partner. You also have Sarah's information. We typically handle most of the investor calls. So anything that you need from us, sincerely, please feel free to reach out to any of us. Thank you for staying with me this whole way. My voice is getting a little rough here, but I appreciate it once again. We appreciate your partnership and look forward to having an amazing relationship with Windridge Apartments. Thanks again, and we'll talk soon.